Is this sustainable, this extent that companies are staying private for longer, and will the wall of money still come in?
I think what we've seen is a structural change in how companies capitalize themselves. This is driven by some very enduring factors, such as regulation. Sarbanes-Oxley made it more difficult to be public, and aspects of the Jobs Act made it easier to stay private. But I think there's also been a cultural change amongst companies. I think founders today realize that you can build a better, more enduring business by staying private for longer, because you can be more focused on the fundamentals of business building. And I think that has led to an irreversible change in companies staying private for longer. And as a result, we're seeing exceptional world-class businesses of real scale in the private markets.
And now 2026 could be quite the unlock. We could have a $1.5 trillion IPO of SpaceX if they live up to their own hype, which you're in. We could have Anthropic's been talked of for 2026. Even OpenAI has been talked of for 2026. Peter, is 2026 going to be the year? And how do you think about some of your holdings ahead of that as to whether you want to be holding on to them in significant size?
It is unquestionable that many of these companies are of the scale and maturity, solidity, operational robustness to be public businesses. And I think the real question is, when do they choose to enter the public markets? I think it's also pretty clear that public market investors are going to have real appetite for these businesses. I think there are really two questions, though. At what price, at what valuations will public market investors be willing to commit significant amounts of capital to these businesses? And how do the public markets digest IPOs of this scale? The largest tech IPO in history was Alibaba in 2014. That was a mere $25 billion IPO. If SpaceX were to list 10% of itself, even at its current valuation, you'd be looking at an $80 billion valuation. So I think we're in slightly uncharted waters with regards to the scale of these IPOs. Here at Baillie Gifford, we keep our public and private growth equity franchises tightly integrated. And when we own a company that comes to the public markets, if our public teams decide to buy that company, that's based on their own decision. They have to make the right decisions for their public market clients. We can potentially become much owners of these businesses and own them for a really long time into the public markets. Long-termism is in our DNA as an organization. We've been doing growth equity investing for 118 years. We've been doing it in private markets for about 14 years. And we have really been in this part of the private markets, these large growth stage private businesses, for as long as this asset class has existed.
Those names have not been 100% illiquid. The secondary market has been fascinating. For transparency and context, Baillie Gifford came in for criticism by Saba Capital Management, a hedge fund. Park that context. But as the manager on the private side, how do you balance that? The timing of maybe trimming or taking advantage of liquidity moment, tender or otherwise, or not, holding on to it and growing?
I think that's a really interesting observation, Ed. And that first wave of companies staying private for longer, I would say up to the 2015 stage, was driven by the provision of primary capital to fund companies' growth in the private markets. What's led to these mega cap private companies is that we're seeing more secondary market transactions happening, meaning that secondary market requirements can be solved whilst companies remain private. We've seen that in the likes of SpaceX, we've seen that in the likes of Databricks, in ByteDance, in Stripe, and that is really enabling companies to put off these IPOs for a really long time. Our job is to manage portfolios, and selectively we will occasionally look to trim our positions in private markets if we're wanting to realize some of those gains, either to recycle into new holdings or distribute returns to our limited partners.
I'm really interested in how strong and influential you feel Baillie Gifford is. With respect, Peter, I've broken a lot of news, over the years on SpaceX or whatever. But the composition of the cap table, like SpaceX, you've basically got Founders Fund, Fidelity, and Google, not necessarily in that order. And like all late-stage growth rounds pre-IPO, the crossover investors want to come in. They want to anchor a future IPO. Do you have influence on the management at SpaceX? Do you try and be constructive operationally in working with them in the direction they want to take the company?
So we try to focus our value-add capabilities on the things which are particularly pertinent to growth stage companies. We're not trying to do venture capital, we're trying to do growth equity investing. And that means the ways in which we have to influence companies need to be designed to the growth stage. So, for instance, we will often play a role in helping our companies shape governance frameworks, transitioning to independent-led boards as they think about becoming public. The public markets is where we've been for 100 years, and we bring that expertise in helping our portfolio companies get ready for being a public business. But that's not something that we try to do 6 months before a company becomes public. We try to do that in the years leading up to being a public business.
So when you're looking at an Anthropic, for example, and there are actually more companies, analysts at banks now analysing private companies because they're so huge. And one of the analysis really coming from JP Morgan, for example, is that the premium pricing that Anthropic has might start to be hit by the level of competition in the enterprise. Is that something you steer a company on or something that you agree with?
Look, I think that when we're investing in a company like Anthropic, fundamentally what we're trying to do is determine not just how large the revenue base can be. We're trying to determine how much of that can flow down to profit and how large that profit can be relative to return on equity. So, of course, we're trying to understand pricing power dynamics, we're trying to understand margin structures, and we're trying to understand capital intensity and the returns that can be earned on capital. Clearly, the AI markets are pretty hot at the moment. We think whenever you have a market, there will be a tiny number of exceptional companies. And so we own Anthropic, we own Databricks, but we're not an AI fund. We're trying to find the best growth companies wherever we can find them. And often you find them in areas where people aren't looking.
Peter, I wish we could do 30 minutes with you. We can't. Very simply, things have changed. You have retail investors coming in via these big SPVs, pension funds I talked about with SpaceX, and then basically Gulf sovereign money. How is that changing the market for you? And again, let's go back to valuations in that context.
I think the truth is private markets are not democratic markets. So companies still get to choose their investors, and companies will still anchor towards or steer towards value-added partners and partners who they believe will be with them for the long term and can support them. But I think it's really important to point out that the demand and appetite for these kind of large late-stage growth companies is very rational. To give you one very tangible example, Tesla went public in 2010 at a $2 billion valuation. Today, SpaceX is still private, valued at $800 billion. So there's a 400x difference there that historically the public markets had access to. And today that growth is happening in the private markets. So I think it's perfectly right that people are wanting to get access to these companies. And I guess the journey that we've been on over the last 14 years has been helping our clients maintain their exposure to the growth of these world-beating companies, despite them remaining private for longer.